it's in an attempt to make the dollar seem stronger than it is, because gold and silver, rising gold, is the barometer of the health of a currency. It is the canary in the gold mine.
We wanted to talk about some developments that have happened. There's been so much going on in the geopolitical and financial world. One thing that was definitely what people have been watching closely is this notion of the role of gold emerging on the stage of the geopolitical and financial war. This economic war, financial war that's raging between the West and Russia, for example, and it's funny because after decades of being told, downplay the role of gold by Ben Bernanke and by others of officialdom in the U.S. saying, oh, it's a pet rock or it's a barbarous relic or whatever, and why would anybody be interested? You've pointed out for years and years that the central banks have been accumulating it hand over fist while telling people it's meaningless anymore. And yet suddenly, when it's time for economic war or financial war to break out, and the U.S. starts putting Russia in the hot seat as far as sanctioning, and I'm sure you'll have some words to say about that. Some of the first announcements from Russia, from Putin, are as far as backing and pegging or tying the value of the ruble to gold. And we even had Jim Rickards come out and say that the ruble was pegged to gold. There have been other analysts. I'll put a link in the description of this video to another analyst who says, no, that wasn't able to hold, that got broken. It's no longer. My question to you is it possible, or does it appear likely, that in addition to the longstanding justification, if you want to call it that, motivation that the U.S. Treasury would have had for wanting gold to look bad was to make the dollar look good, was this now a double incentive to punish gold, to punish the ruble, which had been pegged to gold, and therefore to punish Putin vicariously? So you get to make the dollar look good, and you get to make the ruble and Putin look bad by punishing gold. But then if it got punished enough to drive it below this 5,000 rubles per gram of gold peg that they had established, that got breached, were those pushing down the price of gold so successful that they actually accomplished breaking of the Russian peg of the ruble to gold? Your thoughts on all of the above?
Yeah, well, I mean, look, you definitely hit it on the head there. And when you and I were talking offline, your comments to me made tremendous sense. Obviously, when you're talking currency wars, if that's what you want to call it, a la Jim Rickards, they had great incentive to make the dollar appear stronger than it always is. That's been part and parcel to the suppression of gold and silver, I would argue, forever, that it's in an attempt to make the dollar seem stronger than it is, because gold and silver, rising gold, is the barometer of the health of a currency. It is the canary in the gold mine. And so not only did they have the incentive to make the dollar seem stronger than it was in a period of massive inflation, but they also had, as you mentioned, and I completely agree with, the incentive of weakening the lifeboat or the safe passage, if you will, for the Russians to receive payment in gold. And so knocking it down certainly is something that would make great sense under that narrative. At the same time, you also have the Federal Reserve, who is pretending to get tough on inflation. And in economics, there's a term called Gibson's paradox, which we've talked about, I'm sure, once or twice, which is the inverse relationship between real interest rates. Now, I mentioned the word real interest rates, not nominal, but real interest rates, and the price of gold. And you get all of these dum-dums on CNN or CNBC will say, well, with interest rates rising, it's not so good for gold. And what they're forgetting to tell us is that it's the real thing is real interest rates. And a Federal Reserve who, as we've talked about before, it is my belief they will not get tough on inflation. If they wanted to get tough on inflation like Paul Volcker did, he raised the federal funds rate above the double-digit rate of inflation to 19.75%. Not only did that kill the inflation that was roaring, it also killed the bull market in its tracks, because the real rate was above zero, whatever it was at that point. I'm not exactly sure what inflation was, called 17 or 18%. raise the federal funds rate 2% above that, the real return then would have been 2%, even though you're getting 19% return. The real return, when it factored against inflation, is 2%. When we look at it here, Federal Reserve raising the federal funds rate to 0.75%, measured against 9% inflation, the real rate of return is negative 8+%. So it doesn't do a darn thing to the gold bull market. It only allows the talking heads to seem like they know what they're talking about and speak half truths, telling us this is why gold is down. It's the same group of people that tell us when the market crashes, there is a rush to liquidity and people sell their gold to cover their margin accounts. It's what people believe nowadays. I don't believe that. I think it is the exact same thing in a different suit that you're talking about. But in general, I think it's important to understand that pegs usually don't work. Let's take an example. Take a look at the Japanese yen as an example. Right now, the Japanese yen is crashing. And the reason the Japanese yen is crashing is that they have a trend or a range that they want to keep their 10-year treasury in. And as the 10-year treasury is violating that range, they have to sell more yen to buy more treasury to keep that yen in that peg, and it's crashing the yen. The exact same thing just happened with the UST stablecoin and Luna coin. Same thing. This is that UST stablecoin that last I looked was down to like 17 cents. And that stablecoin was backed, and it's interesting, it was backed by Bitcoin, not US dollars, even though everyone assumed it was a stablecoin pegged to the US dollar. It was pegged through an algorithm where Bitcoin and Luna coin were able to make it a one-to-one relationship with the US dollar. And it was one of the biggest cryptocurrencies, the Luna coin anyways, in the crypto sphere. So what happened is that peg was broken because as the UST was crashing, they had to create more Luna coin to back UST. So the massive creation of more Luna destroyed the price. Pegs don't work. And I think that pegs are easily broken. You can exploit them. And so that doesn't surprise me one bit at all. But in the end, it to me doesn't matter. It speaks to the U.S. desperation to hang on to their hegemony, to hang on to their world reserve status, and they're grasping at it. But the smart money, the BRICS nations, they continue to accumulate gold regardless of the West's ability to continue to hold the price down. And I think part of the reason they don't create a fuss is that they're still in the accumulation phase. So they're making it cheap for them to continue to accumulate gold and silver in exchange for dollars that are losing value. So on one hand, the East is happy about it because it allows them to beat us at our own game. And the West thinks that they're breaking the peg and thinks that their sanctions are working and that, hey, they found a workaround and we'll show them, we'll knock down the price of gold. All it does is incentivize those nations, Brazil, Russia, China, India, South Africa, and the rest of them to continue to accumulate gold at subsidized prices. So yes, the breaking of the peg worked. More power to them. It did. But I think much like many of the things that they have recently done again, I think it is going to have unintended consequences that in the end will just make them have egg on their face, if you will.